All right, the next one I wanted to talk about a little bit was number 42, to talk about depreciation. Depreciation is found on the very top of page, number 42 is found on the very top of page 656. So number 42, top of page 656, relates to this depreciation I talked about earlier. So I'm listing, Betsy acquired a new network system. And the network system was purchased on June 5th, 2017. It's 5-year class property because it is presumably a computer system. For $75,000, I changed it to $80 in my problem. She expects taxable income from the business will always be about $175,000 without regard to the Section 179 election. Betsy will elect Section 179 expensing. She also acquired 7-year property in July 2017 for $350,000. Determine Betsy's maximum cost recovery deduction with respect to her purchases. All right, so when I did this problem, I also did 2018. We didn't have to do this, but I went ahead and calculated the depreciation. I continued on into next year because we had a carryover basis that was available for additional cost recovery in 2018. This was not part of the problem, though. But the first part relating to 2017 is. All right, so we have the available Section 179 expense on this 7-year property at 175. That's only 175 is available because, again, 175 expensing may not create a loss. So no matter what we paid for our assets, we cannot take more than 175,000 of Section 179 expensing because it cannot create a loss. All right, so we have the 175,000 in for expensing. We also have bonus depreciation available, which in this case is going to be the cost of the assets. And I'll run through this with you. It'll be the total cost of the assets, and that's going to be the 350,000 minus the expensing. And the expensing here was the 175,000 for 179. And divide that by 2, since bonus depreciation is 50% of the unexpensed basis that remains after we've used Section 179. All right, so now we've expensed, in the first year of purchase, we've expensed a total of $262,500, which is 175 and 87.5. So already we've expensed of the 350 purchase, the 80, we've expensed the entire an amount equal to 262.5. So then the next step is we've done Section 179, we've done the bonus depreciation. Now we get the accelerated depreciation on the first year of what's left, the depreciable base. So if you go to, within the chapter, if you go to the tax tables for a 7-year asset, and those tables are found on page, just checking here to get the right page number, 613. So if you go to page 613, you will see the tax tables related to the 7-year and 5-year property, and then they have also the 39-year non-residential property. All right, so in this case, it is 7-year property. We will use the first tax table. And again, you can also go to the appendix to get these tables as well. So you go to the appendix, appendix 6A1, you'll find the tables in more detail. And you're certainly welcome to use those as well. All right, so in this case, it looks like in the first year, we're going to get a 14.29% using the half-year convention depreciation deduction. So in my example, then I took what was left of our depreciable base, what we purchased minus what we expensed, and then I multiplied that by 0.1429, the amount we got from the table. So we have our maker's depreciation of $12,504. And again, this relates to the 7-year property only. All right, so 350 minus 175 minus 87,500 times times 0.1429 gives 12,504. So the adjusted basis means, all right, this is what's left to depreciate in the future. Again, of this 7.5 of this 7-year property, 74,996 using my values. Okay, so using my modified values, we have depreciation left on this 7-year asset of 74,996. Now let's go to the 5-year property. Well, we can't take section 179 on the 5-year property because we've used it up on the 7-year property. That is to say, we've used up, and let me just read here. Right, we cannot take any more of section 179 because we've already used it up to the point of our income. So we can't, again, the section 179 cannot create a loss. We've used all of it up to the extent of our income. Therefore, there is no section 179 available for this 5-year asset. However, we can take the bonus depreciation on this 5-year asset. And the bonus depreciation on this 5-year asset is going to take its cost, which in my data, I have a cost of 80,000, and then we get to expense half of that right away in the first year under the bonus depreciation. So we're going to expense of this 80,000 using my data, we're going to expense 40,000 right away. That leaves 40,000 left to go to the tax tables, and using makers, I can go and get my rate. Now in this case, I'm going to go directly to the end of the chapter appendix rather than going to the table within the chapter. And I'm going to go and look up the rate for this asset, which is a 5-year asset. And I see on the top of page 6-44 that the rate is 20%. So the first year of a 5-year asset using the mid-year, half-year convention is 20% of the 40,000 I have left, which is $8,000. So again, that's 80,000 using my data minus the expense I've already benefited from under the bonus depreciation gives 40,000, and then that additional or basis that's left of 40,000, I'll go to the tables and take 20% of that as my maker's depreciation. Therefore, after taking the 80,000 cost of this 5-year asset, taking away the expense of 40,000 for bonus, deducting the standard maker's depreciation for a 5-year asset of 8,000, gives me a depreciation that's left for this asset of $32,000. So I can depreciate $32,000 in the future of this asset because that's all that's left to depreciate after this first year. So my total depreciation on these two assets then will be the sum of this 179 expensing on the 7-year asset, the bonus depreciation on the 7-year asset, the modified accelerated cost recovery standard depreciation on the 7-year asset. I'll also be able to expense the bonus depreciation on the 5-year asset plus the 5-year asset's maker's depreciation. So all of these expenses then give me a depreciation for the 2017 on these two assets of $323,004. And you can see I just carried down my depreciable base to start the process again using in 2018. Now here I don't have bonus depreciation available to me. Okay, I recommend that you go to the tables to look at the residence, how to use the residence tables. Remember those not just residents, but non-residents. What I mean to say is real estate. Look at the real estate tables, depreciation tables in the text, starting on page, as I said earlier, 6-47. And remember that those values are read a little differently. Those values are also percentages, but you have to stay within the month of purchase. That's the relevant deduction for the asset. So maybe we'll just take a minute to look at least one of these. Let's look for problem number 43 toward the top of page 656. Let's just take a look at it. I'll get you started on this one. All right, so Janet purchased her personal residence in 2007 for $250,000. She converted it to rental property. The market value at the date of conversion was $210,000. Determine the amount of cost recovery that can be taken in 2017. I changed the amounts for my purposes. It was $250 in the text. I changed it to $255. Just again to give you an opportunity to do the problems yourself using the data in the text. Market value at time of conversion was, I used $200,000, so I changed that to $200,000. So what is the cost recovery? In this case, we're going to take the lower of the two, the 200,000, and multiply by 0.0, I don't know if you can read that in my formula bar, it's 0.03485. So here's how I got this. First of all, I need to know what kind of property this is so I get the correct table. Well, this is a rental property, and it happens to be a residence. So this is residential real estate. Because it's residential real estate, I'm going to go to the table on page 6-47 to find the conversion factor, the depreciation factor, I should say. So the depreciation factor, first thing I look at is when you look at the table 6A-6 on the top of 647, the column on the left is, the far left is the recovery year. And then the column headings 1 through 12 are the months of the year. And you can see we need to, once we get the purchase month, we stay in that month for the entire depreciation cycle of this asset. Okay, so again, this asset, this residential property for part A was purchased in January. So I'm going to use the very first column on page 647. And then I'm going to scroll down to the first year. And it says 3.485. It's the intersection of 1 and 1, right? It's the first month, January. And this happens to be the first year of recovery that we're calculating. So that's 3.485%. So 0.03485 times the cost of the residential building gives us our depreciation.